Here's something most people never sit down and actually calculate. On a typical car loan or mortgage, you can end up paying back nearly double what you borrowed, and it's not because you got a bad deal, it's just how interest works. Today we're breaking down exactly how interest is calculated on the loans most people carry. Car loans, credit cards, and mortgages, and why understanding the math changes how you'll think about debt for the rest of your life. Let's get into it. At its core, interest is just the price you pay to use someone else's money. A bank lends you money, and in exchange, you agree to pay back more than you borrowed. That extra amount is the interest, and it's how lenders make a profit. The rate you're charged depends on your credit history, the type of loan, and current market conditions. But the math behind how that rate turns into real dollars is where most people lose track of what they're actually agreeing to. Let's use a simple example. Say you take out a $30,000 car loan at 6% interest over 6 years. By the time you finish paying it off, you'll have paid back close to $34,800. Almost $5,000 in interest alone, just for the privilege of paying over time instead of upfront. Stretch that same loan to 7 years instead of 6, and the total interest paid goes up even further, even though your monthly payment looks smaller. Longer terms feel more affordable month to month, but they almost always cost more overall. Credit cards take this same idea and turn up the intensity. A typical credit card might charge around 22% interest, much higher than a car loan or mortgage. And if you only make minimum payments on a $5,000 balance, it can take over 15 years to pay off, and you'll pay several times the original amount in interest alone. This is exactly why credit card debt is treated differently from other kinds of debt in most financial advice. The interest rate is high enough that it compounds against you far faster than almost any investment could compound in your favor. Now let's look at the loan most people will take out at some point. A mortgage. On a $300,000 mortgage at 7% interest over 30 years, the total amount paid back is over $718,000, meaning you pay more in interest than the actual price of the house. This is also why extra payments toward the principal, even small ones, can save tens of thousands of dollars over the life of a mortgage. Because you're directly reducing the amount interest gets calculated on. Here's the part that changes how people think about all of this. Compound interest is the exact same mechanism, just working in your favor instead of against you. When you invest money instead of borrowing it, interest gets added to your balance, and then future interest gets calculated on that larger balance too. This is why starting early matters so much more than the amount you start with. Money invested in your 20s has decades to compound, while the same amount invested in your 40s has far less time to grow. None of this means debt is always bad. Mortgages and even car loans are often necessary tools, but understanding the math changes the decisions you make, choosing a shorter loan term when you can afford the higher payment, making extra principal payments when possible, and prioritizing paying off high-interest debt like credit cards before focusing heavily on investing. And on the flip side, it means starting to invest, even small amounts, as early as possible, so compound interest has time to work for you the same way it works against you on a loan. Understanding interest is the foundation for almost every financial decision you'll make, from your next car purchase to your first home to your retirement account. In our next video, we're breaking down how much house you can actually afford, and why the number a bank approves you for isn't always the number you should spend. Subscribe so you don't miss it, and if this helped make interest finally make sense, share it with someone who's about to take out a loan. Until next time, invest wisely, invest with purpose.